Jason, thanks for joining us.
Good to be with you, Frank.
So I got to ask, with the NASDAQ notching a 26th record close, it looks like tech is the place to be. Should we all just pile into FANG stocks, or are there some other names we should look at in the work from home play, or maybe just recession-proof play?
So we continue to be overweight large cap technology, given the moats that these companies have, given the leads and the dominance they have in the markets in which they operate at the business level, given the asset-light business models, the low cost of capital. So we continue to prefer companies like Amazon, Apple, Microsoft, Visa, Alphabet, Accenture, companies that when you look at their balance sheets, carry lots of cash, have flexibility on their on where they can find growth. And I think those areas of the market are attractive to investors. And our counsel is to have diversification in the portfolio. I mean, you don't want to be 100% in technology or in FANG, but continuing to have a sizable allocation to this part of the market makes sense, we think, over both the near and long term.
Jason, what happens if there's a change in control in Washington? Do you think there's any risk to the downside for tech stocks if that's the case? And you think that the market's starting to really consider that, given that it's already mid-July?
That's a great question. And I think that risk has diminished over the past few months, given that Joe Biden is the front runner on the Democratic side. So there's probably a little bit less appetite versus, say, a Bernie Sanders or an Elizabeth Warren to go after, quote unquote, big tech. I think having additional regulation, if we were to see Biden win the presidency and the Senate were to go Democrat, is probably something you can expect over the coming years. But more regulation just means more hurdles for small companies to come in and compete against these large cap entrenched technology companies. I think breakup of Google or of Apple or Amazon is a real risk to investors. But we think the risk of an outright breakup, a la what happened, or at least was going to happen to Microsoft 20 years ago before that changed, is a fairly low risk to investors at this point.
Well, Jason, some of these tech stocks, they basically become utilities, especially in this work from home world.
Right.
Can you kind of give us some of the stocks that we should look at outside of the FANG names, Microsoft, some of those big names that most of us are aware of and that many people feel are overvalued?
Yeah, I think Visa is typically a technology stock that doesn't get much attention and is operating in a duopoly with MasterCard. And despite the fact that we are in an economic recession, I think the long-term picture for Visa continuing to be a toll in just about everything we do regarding our spending, whether it's with Apple Pay or whether it's online or whether it's just swiping our credit card in the grocery store, is something that it deserves attention. I mean, it's a stock that's been a little more challenged over the last couple of months relative to FANG, but we still like the longer-term prospects. We also initiated a position for clients in an ETF called W Cloud. It's Wisdom Tree's cloud technology ETF. And there's a whole host of smaller and mid-cap companies in cybersecurity, work from home, cloud, and some of the areas that we really think are durable long-term themes in technology that I think investors can look to get a little bit of diversification and get outside of that FANG area as well.
Now, Jason, I cover the hedge fund world, and one of the big concerns among hedge funds and people who watch that space right now is that the tech trade is just too overcrowded right now, that people have piled into FANG. It's been working for a while, and people are kind of waiting for that table to turn. Does the crowdedness concern you at all? And do you think that, if circumstances change with regard to the coronavirus outbreak, that we could see a change of heart with regard to these tech names?
Yeah, it's a really good question, Leslie. And the reality is that has been with us for about 7 years now. I mean, even in the bull market, the discussion, and I guess we're in a bull market now, but in the bull market prior to the pandemic for 10 years, the discussion of everyone overcrowding into large cap technology and FANG being a leader in the market for so long. I mean, that was honestly something that, I've been asked for a long, long time, even prior to the situation we're in now. And it just hasn't, resulted in a reason to get out of these stocks. I mean, the reality is if you go back over the last 50 years, market leadership is typically quite narrow. That's a feature, not a bug, of investing in the stock market. So to have these be the new leaders and these new era technology stocks, as we call them, or tech utilities, as Frank mentioned a moment ago, is truly the right way to think about that. So they're not leading just because, it's FANG and this is a storied part of the market and we need to be in. I mean, there is some of that going on, but at the end of the day, these are real businesses with really attractive business models that we want to own. I mean, if you look at the collective revenues of the FANG stocks, if you take out Netflix and add in Microsoft, the collective revenues are about 1.2 trillion for next year, if you look at the estimates. And that's a really strong area to be in as we think about it. So no, I don't think it's overcrowded. I think there's durable reasons why you want to own these names.